how would you know if the way that you're managing wealth with your corporation is even working for you? Let's talk about a few telltale signs that I see when it's obvious that the person doesn't really have a plan that's working. So let's talk a little bit about corporations, your favorite subject.
I don't hate it.
Don't you?
It's just a heavier topic. It's not like an easy one, you know?
I guess you're right.
Yeah. I like how you're like, I guess, as you're like, I love
It's what I do. Yeah, exactly. Yeah. It's the bulk of the stuff that I like diving into. So the reason that I wanted to do this episode was because I've heard it from a few different people now that it's really difficult to know if you're on the right path. Like, what are the actual signs that you're not on the right path? Mm-hmm. In a lot of other things, there are some really obvious signs, right? Like if you're driving down the road and you're lost, you kind of know you're lost. Yeah. There's some obvious signs. If you're in the wrong house, you walked into the wrong house. You know, there's lots of signs that you're off the track. But when it comes to finances, it's kind of one of those things that, because of the way compounding works, mistakes also compound. So you don't really know you're making a mistake or you've made a mistake oftentimes until way later down the road, because the impact is kind of minimal until it's really, really important.
Yeah.
And I get a lot of people reaching out to me at the time when it's now really, really important. And it's like, okay, well, yes, we can still help, but this would have been really nice to figure out ages ago. So we're going to kind of talk about some of those, at least a few things specific for people that own corporations that maybe you need to be looking at some other options. Mm-hmm. So the first one is idle cash.
Okay. Too much cash. Yeah. Tré loves cash, just sitting around doing nothing.
So I recently was asked to reach out to a TCU member that had over $500,000 sitting in a checking account as a corporate checking account, and they had it there for the past like 4 years or something like that. Mm-hmm. So
yikes, bad timing.
Yeah,
based on what I know
after the markets.
That's what I'm thinking.
But that's hindsight, right? So in foresight, what do you think some of the things that person could have known maybe that they don't have? Because that's a telltale sign that there is no plan, right? At that point, you're well aware that there's no plan. You have $500,000 sitting there.
Doing nothing,
sitting in a checking account, not even like a high interest savings or something like that. Like where there's some resemblance of a plan, like just sitting there doing nothing. So you know something is wrong, but that's so much later. What do you think some of the things that individual could have clued them into the fact that they didn't actually have a plan?
Like the corporation owner?
Yeah.
Well, I'm thinking like, I feel like it sounds redundant, but the fact that they have cash building up is like, okay, I obviously don't know exactly what my expenses are versus like, what do I need in my operating account sort of thing. I said operating account. They're like, I knew something. Anyways, like, what do I need this money for? How much am I paying myself, my employees? Do they have employees? Is it like all of these other questions? I guess it kind of sounds simple, but it's like, oh, I have cash sitting here. I should probably, or like year one, maybe, if you're like, okay, I have all this cash left over, maybe I should be re-looking at all the numbers again, either with your accountant or with your advisor, whatever, to look and see what your actual numbers are currently. What are you projecting for your business? Again,
call it burn rate. So like how quickly the individual goes through cash, like how the business, how much cash does it use?
Mm-hmm. I was going to reference Shark Tank because they're always like, what's the valuation? What do you think for next year and the years ahead? Because obviously the point of having a business is to continue to grow or like be profitable.
Yeah.
So if you already have excess cash, it's like, can you expand? Can you use it for other, whatever, business ventures? Can you invest it? Whatever.
Yeah. So along those lines, yeah, you're absolutely correct. Like there's lots of things that you, at the very beginning, they could have known or been able to see that this was going to be a problem. Here's like a test for you if you have a corporation, you're thinking, do I have a plan or not, is if I gave you $100,000 in the corporation and it didn't have a purpose for the business, what would you do with it? And if you have no idea, you very likely don't have a system or structure in place that's going to work.
So question, when you say that, do you mean for the business specifically or just in general? Like, oh, I have $100,000, even though I don't have a plan for it business-wise, I might invest it? Is that like...
Exactly.
Is that
you're
another
thinking.
plan?
The fact that you wouldn't know is the telltale sign. The amount of people, professionals that I still meet with that don't even realize you can invest inside of a corporation.
I just asked you this last year when we started doing this. I'm like, but wait, can you invest?
Yeah,
you're
but
like,
you're not an engineer of 30 years. And
yes,
it's like the amount of, it's just glossed over because your banker often probably won't even know or understand the way that it works, let alone the tax consequences of it.
Yeah.
So not having a clue what you're doing with the cash, whether that be just sit there, if that's the plan, if that's what you're going to do, you don't actually have a plan and you don't have a way of structuring it. What I actually encourage a lot of people to do, even if it's not optimal, is to open and start all of the accounts that you're going to need eventually anyway. So I will start them, if they have a corporation, I'll start them with a small investment account. We'll put $10,000 in there. It's not a big deal. The point isn't the dollar figures going into it. The point is that you already have the system set up. So when we're making decisions on what to do with cash,
you don't have to go and do all that
brand new account we have to open that we put on the back burner for the next 5 years because we don't really want to deal with it and go in and sign documents. And like it happens all the time to people. Yeah. But if you start properly and you're like, okay, well, corporation owner, we're setting up a corporate account for investing. We're setting up your TFSAs, all your TFSAs, your RRSPs, we're spousal. We're setting it all up. Whether we use it or not is irrelevant.
Yeah.
Everything is set up so that when it comes to, okay, now what do we do? How do we allocate this cash in the best way possible? It's not a case of what do we do with the money? It's where do we put the money? Yeah. Because we know for a fact we do not need it in the corporation, in the operating side of the corporation.
Yeah.
So therefore, that is not where we put it. There's always somewhere better for it, is the way that I encourage people to think, right? You keep what you need for the operating costs, same as your personal expenses. You keep budget very similar.
Yeah.
You keep what you need for your operating. Everything else needs to find a better home.
I feel like people are probably like me. Maybe not, though, because I do not own a corporation. So maybe these people are quite different. But I would assume some people would be like, but what if I need more cash? Like, what if something comes up? And, it's just like having those
super
answers.
common. Absolutely. Yeah.
Because I think it's one thing to budget personally, but I do think for a business, it's maybe a little scarier because the numbers might be bigger. What if we have a huge expense like what's a huge business expense? I don't even... You guys would know, right? You fill in the blank for this one.
It could be like you're expanding or something like that. You're purchasing property. There's a bunch
of... like an opportunity almost. Something comes up and someone's like, hey, do you want to invest in this other part of... You could expand your business this way, but it's kind of...
A lot of people don't know that or don't understand that things aren't always locked away for, especially if they're raised on GICs and that's all they've ever had access to.
Yeah, it's like the idea of pulling out of the markets again. It's like all of these things, the mentality of it. It's not locked in, but then you're like, but this isn't for this. You remember we talked about that? Like being able to pull from the investments, like personally, I wonder if it would translate as well. But anyways, that's beside the point. It's just some things I'm thinking like, oh, if you were in their shoes, maybe these are some of the reasons you would hold off doing it, some like more with the cash, I guess.
Absolutely. Yeah. I think lack of knowing is a major thing. Not wanting to make a mistake often leads people to inaction, which is like one of the worst mistakes. Doing things suboptimally is better than doing them
not at all.
There's a few things, but it's just the telltale sign that you don't actually have a plan, you don't have a structure. But the time that you have, especially for small like professional corporations and stuff, where maybe you have $200,000, $300,000, $400,000 of revenue, by the time you're accumulating like $50,000 of cash, you should be looking at what your long-term plan and goal is for these funds. That was working with a new client that brought him on last year, I think it was last year, and he owns a physiotherapy type of corporation. And yeah, we started when he got to about $30,000 of cash, and he just lets me know like once a quarter or something like that to move over an extra $20,000-$30,000. And it's really simple because we've took the time to set up the process, and so we know what we're doing right with this build up cash. We know how much we actually need and things like that. So
Yep.
those things, yeah, really really common thing that happens to a lot of people. So that's the first thing. The second thing is that whoever you're dealing with right now, and I've said this before, but I'll say it again, not every advisor in Canada is a financial planner. And not every financial planner can deal with corporations. A lot of people will have an investment person who all they do is manage investments, and they'll think they have a financial planner.
Yeah.
So, and this is really important, especially for people that own corporations, because there's so much more complexity to it. So if your individual has never discussed taxes with you, you need to find somebody else. Just, I don't care how much you like them. Like when it comes to investing and growing wealth, when you're investing outside of typical RRSPs and pensions and things like that, it's a whole different ball game. You don't have to know anything about tax really to help somebody accumulate assets inside of a RRSP. It's very difficult to screw that up. But when it comes to the other side, it's very easy to screw it up if you don't know what you're doing. So if your advisor isn't discussing the tax side, that's another red flag that you don't really have a
plan.
Yeah, you actually have a plan for how you're accumulating, let alone the deaccumulation phase of your life. I'm not even going to touch on that, but let's just focus on the accumulation stuff. The other thing is that you've never visualized what an exit would be like.
Like either selling, retiring, whatever.
Yeah, so that's really important when it comes to how you accumulate assets. Because if the goal is to exit a company, there are certain tax benefits you really, really want to be able to access. And you could put yourself in a situation, especially when you include insurance and stuff like that into the picture. But you could put yourself into a situation where you're paying, it's not like a few $1,000s more. It's like hundreds of thousands of dollars more in tax because you don't qualify for capital gains exemptions for this reason or that reason. So that's another really important thing where you should have, and certain types of companies are prone to certain types of exits. Like a professional services company, typically you're winding down, like a lawyer is typically winding down the business. That's very different to an engineering firm where you've bought shares and now you're probably going to be selling those shares and what that looks like. And those type of things have various tax consequences, and the way that you would accumulate those shares and stuff like that depends greatly on how you're planning to exit that business.
Yeah.
So that was the other thing. So the three main things that really you should be looking at, or should be red flags that will go off in your head to know, okay, I need to spend more time in this area.
So it was, how much idle cash do you have?
Yeah, just sitting on idle cash.
Yep. And then your planner not talking to you about taxes.
Yeah.
And then you were just talking about the engineering shares and stuff. Exit strategy.
Look at you go.
I had to replay that real quick in my head.
And then this is the bonus one, I guess, because this is definitely harder for you to see. You have to have a level of financial literacy to understand this. But if you're looking, I want you to go to your statements. And this is assuming now that you are investing, you do have an accumulation strategy, you do have the type of things. But I want you to take a look at your portfolio that's inside of your TFSA, RRSP, and corporate account. And if they are all the same, like exactly the same, that's also a big red flag.
Well, number-wise? Like, hey,
not the dollar figures, what it's invested in. So let's say for every account they have you in I'm going to just throw it out there, like a RBC balanced fund, and that's in your TFSA. That same RBC balanced fund is in your RRSP. And then inside your corporate account, you have that same RBC balanced fund. That is a big red flag, because when it comes to investing, in outside of RRSPs and TFSAs, even with TFSAs, so we'll say specifically RRSPs, you have to factor in tax. And just like we learned a little while back, certain types of investments are taxed in certain ways.
Yeah.
And when you were looking after the whole thing, you have the ability to put more tax efficient types of investments in certain places to get the best after tax return. So that's another red flag. That's the bonus red flag, that if you can go take a look and see, because there are a lot of mistakes. I see mistakes made with asset location all of the time. It's probably the biggest mistake there. And it's simple to get right. It just means that you have to the advisor has to educate the client and has to put in that work a little bit, because it's a little bit more complicated, but it isn't difficult to get right. So if that is not being looked at all, again, it comes back to the advisor not
knowing what they're doing, or just taking maybe a shortcut or something, like is just not quite.
Well, so because it's relatively easy to do, the more likelihood is that the advisor doesn't know, which is very common. It's fair. I would say that I could have a very good career never touching corporations in Canada. The vast majority of people do not invest in corporations. You could have an incredible retirement practice focusing on average employees and be a very good planner, right, for that subset of people. You can be an incredible planner for that and never need to touch corporations. So most people don't. Like, you don't have to. Why would you?
So if a client comes to them and they're like, oh yeah, I'll help you, but it's not optimal for the client because the advisor, that's not where their specialty is.
No,
sort of thing.
And it could be somebody that you worked with for ages, right? Like there's lots of people that they'll be an employee for many years and then they'll go and buy into a
or your
company
parents'
or something.
advisor, and then all of a sudden you're actually an engineer who now has bought into the firm, and it's like you're a corporation owner or have bought shares or whatever. So it's like your circumstances have changed. But this is my dad's advisor that I've known for
I don't know if
whatever.
the dad's advisor would be the.
But it's like
the
if you've
allure,
worked.
but it could be, yeah.
If you've worked with them for what's happening? If you've worked with them for a really long time, then or known of them or
Exactly,
whatever, it's
yeah.
like the trust thing, right? Like,
You've been with them for 15 years, and
but again, remember, let's loop it all back to episode. It was super early. I can't remember, but we were like, just because someone has good intentions doesn't mean they're giving you good advice.
Yeah.
So you may trust that person
to give you what they view as the best advice.
Yep.
And I don't doubt that they are giving you what they view as the best advice. It's just simply, you don't know what you don't know.
Yeah.
And this is one of those worlds where I would say, because I was in that boat, I had no idea the rabbit hole I was going down.
As you started, you're like, this is fun.
Yeah.
I love reading the tax code.
Yeah. It's one of those things that the more you learn, the more you feel like you don't know. And then you look back, you're like, oh no, okay, no, I've come a long way. It's just there is so much to learn. You're always looking at better ways. And if you're somebody like me, you're always trying to find better, more optimum ways to do stuff. So it's always a learning process, which is fun. But yeah, so they're the things. Okay. So
Perfect.
if you are in this situation, or you know somebody in this situation that has a corporation, or you probably wouldn't know that they have a corporation, what would you say? I would say anybody that is doing really well in their career and they are a professional should be paying attention to this type of information. Anybody that is running a sole proprietor company, first of all, there's tons that you can do before you become incorporated, so you should definitely do all that stuff first. But that being said, if you have a friend or something like that is in that world running a small and they're expanding and want to grow things, again, they're the type of people that needs to know this information, because decisions you make in your 30s make a big impact for when you're in your 60s, 70s.
Yeah.
So
Yeah.
okay, that's the end of that episode. See, wasn't so bad, right?
Yeah, wasn't bad.
Oh, wow.
Wasn't bad. I'm just kidding.
So happy. Okay. And we're going to do a future one. I got some really good feedback on the default options.
Oh,
so
good.
we're actually going to do an episode on default options for corporations
Okay.
in a little bit.
Perfect.
Don't know when, but it's on my list now. So
Maybe it'll be the next one.
maybe it'll be, who knows. Okay, perfect. Well, we will see you guys later. Thanks for listening.
Bye.
Bye. Thanks for listening to this episode of the Plain English Finance Podcast. Tré Bino, Certified Financial Planner, Chartered Investment Manager, is a financial planner with TC Wealth Management and Aviso Wealth. You should always consult with your financial, legal, and tax advisors before making changes. This podcast is provided as a general source of information and should not be considered personal investment advice or solicitation to buy or sell any securities. The views expressed are those of the individual and are not necessarily those of Aviso Financial Inc. Mutual funds and other securities are offered through Aviso Wealth, a division of Aviso Financial Inc.